Hey, welcome everybody. Let's talk real estate. Your weekly BS with Barry Saywitz about the current commercial real estate market here in Southern California. As we take a no BS look at both sides of the issues driving this market today to find the best solutions going forward. With our man right in the middle, it's Barry Saywitz. Hey, Barry.
Hey, good morning, Paul. Good morning to all of our viewers and listeners out there. Welcome back again for another week of Let's Talk Real Estate. I'm Barry Saywitz, president of the Saywitz Company and managing partner of Saywitz Properties. And if it's Tuesday, we're talking real estate. And so we're back here again. If there's one thing that I've learned in my 30 plus years of doing this, it's to look at both sides of the equation, try and make an informed decision and come up with the best solutions possible. I'm excited about today's show. We're going to take a little different look and a different dive into one of the niches that we have not explored yet, which is the niche of commercial real estate in student housing, which affects people all over the country and here as well, again in Southern California. Before we get going, I want to do a shout out to all of the folks out there in the air conditioning industry, all the technicians and all of those air conditioning vendors. It's a warm one here in Southern California. I have no jacket on today, and it's warm in other parts around the country. So thank you guys for all you do out there and keeping us cool when you can. With that said, I want to welcome today's guest, Andy Aitow, who is the chairman of SAM National Properties and also owner of his own real estate company. And Andy is with us on Zoom today from his home office in Chicago. Andy, welcome to the show.
Thank you, Barry. Great to be here and excited for this.
Yeah, and so you are no novice to the real estate industry, longtime owner of your own real estate development investment company. But you have a side job, if you will, in terms of being chairman of the SAM National Properties. And SAM stands for Sigma Alpha Mu, which is a fraternity organization which is national throughout the United States and has a long, long history of being in existence and having chapters throughout the country. And the SAM National Properties is sort of an outgrowth, if I understand it correctly, of the fraternity itself. Maybe you can explain.
Sure. Yeah. No. It's an idea that was born out of a need for better quality housing, and it's really been a transformation in the student housing world in general, with the quality and the condition of student housing changing and really being institutionalized. And fraternity housing still, for the most part, hasn't evolved. It's starting to now, because of the desire by the tenants, by our customers. And that's really where the idea came from, is that we need better housing. We need to provide the amenities and the finishes that the luxury buildings are starting to offer students. Otherwise, we can't attract members.
And for those people not familiar with it, I'm living it firsthand with my son going off to college in a week. But when kids go to college, they have the option of either living in the dorms provided by the university, live in an apartment or some other residential housing near the campus, hopefully, or they go into some sort of group type of a housing, whether that's a fraternity, a sorority, or some other type of managed living arrangement. And they all have different pricing structures and different amenities, whether it's food or other common living environments. And so with the idea of the SAM National Properties, as I understand it, the goal was to be able to not only provide quality housing in the places where you guys had organizations and chapters and members, but also to be able to control the real estate as well.
Sure. Yeah. I mean, as you know yourself, as somebody who invests in multifamily housing, values of real estate, they only go up over time. And for the fraternity, historically, it's always been non-for-profit approach to housing with no real interest in. The fraternity never really had an interest or a profits interest in the long-term value of these properties. So the non-for-profit housing corps would own them and operate them, and really operate them like a traditional non-for-profit would, which would be to keep the rents as low as possible and kind of do the minimal to just provide shelter for the students. And it's unfortunate because over the years, and I mean, I'm still relatively young, and over the 20 plus years that I've been involved as a volunteer, we've the fraternity, when a chapter closes or no longer is in existence there, the housing corporation, who doesn't really have a for-profit interest, just sells the property for whatever they can get. And that's a loss of incredible amount of value over time. And some of these properties 20 years ago, since then, they've doubled in value. So, long-term equity building and wealth creation for the national organization is certainly a part of the strategy, and will make the fraternity, national fraternity, long-term, a lot of money.
Well, and so you really, it's sort of a dual goal, I guess, if you will. Not only are you providing hopefully quality housing, hopefully low cost housing and amenities for your members, but it's really an investment tool for whether it's the fraternity as a whole or whether you bring in outside investors to control the real estate and actually hopefully turn a profit at the end of the day. I know from my own experience of being in college, there was an opportunity to buy the fraternity house that I was in, that I lived in, for I think $400,000, and I think today it's run as an apartment building and it's probably worth $10 or $15 million. So it's not even double. It's whatever exponential fold here in Southern California. Other parts of the country certainly different, but no different really than investing in any other type of real estate. If you're in it for the long haul, you should make money. It should go up in value. Is that sort of the pitch to the investors or the people that go in on these types of deals?
It is, yeah, and that's unique. For-profit housing is not typical with fraternity houses. Typically, it's non-for-profit, and the weird thing about that is that your investment, or the money that you traditionally would put into a fraternity house, was not even tax deductible. It's an exclusion under the tax, with the IRS, that if you give money to a fraternity house or a sorority house, only a very, very small portion of that can be tax deductible if it's educational use space, like a library or some other space like that. So it's always been a very difficult, opportunity to go after people and say, look, give money to this organization, to your fraternity or sorority, because you love it, not because you're going to really even get a tax deduction for it. So now what we're doing is we're saying, all right, these are for-profit investments. You will always own a membership interest in this property. And as the value goes up, you can also, your membership interest will increase in value over time. And that's been very appealing to investors.
Yeah, so you've taken it really to a different level where you're bringing in outside investors. So I guess talk about that for a second. Who's the kind of person that would invest in these deals? Is it alumni? Is it outside third-party investors looking for a return? Is it all the above?
I mean, really long term, it's all the above. In the short term, because it's somewhat of a new concept, doing for-profit fraternity housing. Proof of concept a lot of times takes showing that this works. So early deals are mostly alumni of the chapter that we're working on a project at. We have had some interest in investing in multiple opportunities. So an investor in our project in USC, actually a few of the investors in the property that the Sigma Alpha Mu did at USC also invested in the University of Illinois project, which is now ongoing. So we're starting to already see that some of the current investors are looking for the next deal. That will then lead into bringing in possibly some larger investment groups, maybe even in some institutional type capital as this thing scales.
And so you guys really have already expanded the investment piece of it on a national basis in different markets for major universities. And then does that give you the opportunity to, is it the real estate first? Is it the chapter first? Is it really on a case-by-case basis? And then I guess part two of my question would be, what kind of a return does an investor get in terms of percentage on these types of deals?
Right. So the strategy for Sigma Alpha Mu has been to focus on campuses where Sigma Alpha Mu has an existing chapter or an existing property. We may have a dormant chapter that will come back in the future. So the goal has been to focus on those campuses. And if a new opportunity were to come our way, part of the due diligence process would be to look into whether this is a viable real estate first, is a good quality real estate in a good quality location on a major university. And this is a place that we believe not only would Sigma Alpha Mu have an interest in housing there, would another fraternity or sorority be of interest if Sigma Alpha Mu were to be dormant at any given time? So it's really making sure it's, I think I would say answer your question is really about the real estate first. And then second, most important is this a good campus for Sigma Alpha Mu and other fraternities and sororities? Is it a strong Greek campus? Your second question, which is, returns, the typical yield or unlevered yield on the projects is tends to be higher than what you're seeing in the student housing market right now. That market, and I know it's evolving with interest rates changing out there, but you're seeing cap rates compressed down to 4 to 5% in the student housing market. The fraternity housing historically has always been valued a little bit lower because of I guess the abuse on the properties. But we have professional management. We underwrite the annual repair and maintenance line, and try to keep the property as close to what we deliver it today over time by continuously putting money into it and maintaining it. So if we're underwriting 7 to 8% yield on cost on these deals, sometimes as low as 7, but we're seeing stuff as high as 8 yield on cost, and that's unlevered, right? So the levered return is in the low double digits.
Yeah. So from a return standpoint, from an investor, much better than a typical apartment deal that's out there. I guess the difference is, if they throw a big party and break some stuff, then you've got to have an accommodation for that.
Right. You do have to have a high reserve annual maintenance cost, and that is something that is underwritten in all the deals. And we haven't had too many major issues because we have regular contact with the membership and maintaining the property. We inspect the properties annually and are putting in the necessary repairs so that when the guys come in the next year, they have a level of detail that they you kind of treat the place as its condition, right? So if you're living in a dumpy place, you're likely to treat it like a dump. If you're living in a higher quality apartment or building, you'll treat it with a little more respect, and that's and you guys concepts there.
But with Sam Properties, there's professional management that's
right.
overseeing it. So from an investor standpoint, the reality of it is you write your check, you pay your money, you get your return, and somebody else is doing the professional management. You're not having to deal with the day-to-day aspects of running the organization. There's management in place, correct?
That's correct, yes.
And then also, as I understand, maybe you can elaborate on it, you've now branched out into actually doing third-party management for other fraternities, other sororities, and other types of student housing organizations using the same platform of managing these properties.
Yeah, so management, anybody's in the property management business would know that it is not a big profit center. It's expensive to provide the high quality of service that the tenants demand. The reason we've decided to look for third party is to offset some of the infrastructure costs that Sigma Alpha Mu has invested in. We've been talking to some other fraternities and sororities that also have dated portfolios and are not sure themselves how to bring them up to today's standards and how to bring in professional management. So we've started to pitch the concept to other groups and getting a nice warm reception from many groups. It's a long process. These are organizations that have been doing the same thing for over 100 years. So getting them to do things differently is going to take some time and some arm twisting, but there's a lot of need out there to kind of institutionalize the fraternity and sorority housing business.
But really, Sigma Alpha Mu is one of the few organizations that's doing this out there, not only for themselves but for third party.
I was told by our insurance carrier that we're the only group in their entire portfolio that is offering third-party management services to other fraternities and sororities.
Yeah, so it really is cutting edge.
They wanted to understand why we're doing it and how we're going to, mitigate any risks that we're taking on.
Yeah, but doesn't that also lead to other opportunities for purchasing properties as time goes on? So that if you're controlling the management, no different than a typical property management company or a listing brokerage company, if you're managing the property, you have first crack at when they're looking to dispose of the property. of creating opportunities. So, Andy, talk about some of the specifics of the deals that you've done. You mentioned USC. I'm familiar with that one. Where are some of the other locations that you guys have done transactions in the last few years, the different campuses around the country?
So the first project we did was acquiring or inheriting our project in Ann Arbor, University of Michigan. Unfortunately, at the time that we were without a chapter there due to some risk management issues, and we inherited that property from the House Corporation. Quickly did some renovation work, put a sorority in there. They vacated the property a couple years ago, had a fraternity in there for 2 years. Now we have another sorority for a few years. Fairly straightforward. We just bought it, or inherited the existing building, and have done some minor repairs. So it's not a big story there, but overall, the professional management has allowed us to maintain that asset, and the value has continued to go up. The cash flows have been strong to the organization, and historically, when we lose a chapter, we would have sold that thing for, I think at the time it was worth $1.5 million. It's probably worth $3 million today. So I mean, that's just we've.
So it's all about it's all about preserving the real estate, because in that instance, right, you basically rent it out to a third party, and you'll just wait for another day in terms of the operational side. But for your investors, there's still income coming in. The concept's still the same. Yep.
And that House Corporation owns the asset 100% because we didn't have to do any major work there. So long term, the benefit to that House Corporation is when our chapter comes back, which is going to happen in the near future, the cash flows that property is providing will provide scholarships to the members. It could provide subsidies to tenants that can't afford the rent. I mean, all kinds of amazing benefits. So I'm super excited when that chapter comes back and we can start to really see the benefit of maintaining these assets long term and what it can do for the membership.
Hey, but you've done stuff at other major campuses, right? So
yeah.
Arizona, Illinois,
right,
Texas, Rutgers, some of these bigger campuses around the country. Does it make sense to do it at smaller campuses, or I'm going to guess that the larger campuses provide some more economies of scale and stability?
You really need to be on a major campus where there is a relatively large pool of fraternity and sorority organizations, and that the reason for that is that unfortunately things do happen with fraternities and or sororities over time, and there are risk management concerns. And if you look at it from a real estate investment standpoint, you always want to know what your backup plan is, and if something happens to the organization you're leasing to today, well, you need to find a new tenant. And larger campuses have typically more demand than supply in fraternity and sorority housing. The cost of building a new fraternity and sorority house is exorbitant, and you having older property that you can renovate or maintain is always less expensive, and a better opportunity for them to lease. So major campuses are first high priority for sure.
And you guys have in-house construction in the sense that you have people within your organization that can help oversee or guide through the construction process, either when you acquire a property or just going through your normal maintenance, which is another key issue of just dealing with upkeep of the properties and making sure they stay intact.
Without question, yeah. We have a board member that owns a construction company, does renovation work around the country in the hospitality industry, and he's using his network and team to help us with our construction, and really incredible to have him as part of what we do. As myself as a developer, I know that finding a trusted general contractor is one of the most important parts of the project for a variety of reasons. I mean, the first is just even cost control. General contractors can bid things all over the board and all of our projects, and finding a low cost provider that is going to build a quality product is one of the biggest challenges in development. So having him on our team is just amazing. I mean, our project in Illinois is going really well. He's doing an amazing job. That's I didn't talk about that one yet, but that's something that we're going through the development process now, and we'll deliver in October. So he's keeping it on schedule. It's on budget. Very little use of the contingency. And it's a fairly complicated project, and we're gutting the entire building.
Interesting.
We remove the roof, increasing space in the top floor to add bedrooms, adding bathrooms, all new plumbing, all new electric, all new mechanicals, new roof, new windows. I mean, it's a big project.
Sounds nice. I mean, you want to move there. So we just have a couple of minutes left. Time flies by quickly. We could talk about this stuff all day. I have a couple of other points I want to touch on real briefly. One, on the lending side, are there lenders out there that will lend on these things? I mean, you bring in the investors for the equity piece, but I'm assuming that there's a bank that you go to for first trust deed at the end of the day, or even at the beginning of the project.
Yeah, certainly those relationships, historical relationships, are really important in this business right now, because it's not really a true and tried business running these things the way we're doing them. So we've been working with a bank out of Indianapolis called MBOI. They've worked with Sigma Alpha U for many years and have essentially agreed to lend. It's not a guarantee, but they lend anywhere we have a chapter. So that relationship has been really important, because we don't have a person to sign the loan. This is an organization that is running these things, right? I'm a volunteer. I'm not looking to put my personal guarantee on these loans, and that relationship's important. So we did identify recently another bank that we're starting to form a new relationship with through one of our national board members, and that bank is starting to is going to lend to us at our Ann Arbor location, because it's an existing established property. Heartland Bank is the name of that bank, and they've stepped forward with a term sheet there. So
you've solved the lending. You've solved the lending piece, so that if you need dollars for that aspect of it, you can go get it.
But it's not. I wouldn't say it's 100% solved. We have relationships that we've worked, right. But if you just walk into this as a newbie, and you don't have existing relationships, it's tough.
Yeah, no, I agree. And the lending piece, especially in this environment with rising interest rates, which sort of leads me to my next question, which is, where do you see things going with interest rates rising, with a volatile stock market? Are these deals, and is the growth still viable, and does it create additional opportunities with other people potentially struggling, which may create opportunities for you to pick up more properties in the future?
Yeah, I think there will be buying opportunities without question, because not everyone's adopting the philosophy of keeping their fraternity or sorority house on up to date, and investing in that property to attract the best quality members that are willing to pay proper market rate rents. We haven't seen the real post-COVID effect on rents yet. We don't really know where that new level is going to go as of today. I think we're going to start to test those waters over the next year or so. It really was two very difficult years, the last 2 school years. This upcoming school year, I think, will finally be the most normal school year that we've seen. And on-campus housing, should be very strong, which would allow us to push rents a little bit more aggressively. But that really would help offset the increase in borrowing costs if we can really grow our rents significantly. But I'm sure 10-year is still staying relatively low. Interest rates have not really hit commercial property too hard yet. I think it's yet to be seen what the impact is going to be.
Well, and it seems to me that if the need for housing is there, especially around these major campuses, there's always going to be a need, assuming kids are in school, for decent, affordable housing, and so you have a built-in customer base, if for lack of a better word. So I think that it sounds like these investments are really viable in the long term and should pay off, COVID aside. And it sounds like that your organization is really at the cutting edge of these types of investments in terms of structuring them and in terms of how they're managed.
Yeah, it's really important. I mean, number one reason why parents don't want their son or daughter joining, well, mostly sons joining a fraternity, is because the housing is terrible. They don't want them living in that property. It's filthy. So if we can flip that script and actually provide them quality housing, the fraternities have amazing benefits, right? And all kinds of social benefits, career development benefits. If you can eliminate the quality of housing issue, you've taken a lot of the barriers off the table, and should should really make them more desirable.
Yeah. No, there's no question. And so it's an interesting concept. Is there one thing that keeps you up at night in terms of the economy and where we're headed, whether it's inflation or gas or the election, that you think may have an impact on this type of real estate structure going forward?
I think the biggest thing that would keep me up at night is just looking. There's some statistics that have been out there showing they're calling the cliff in student enrollment coming up in 2025, and showing that there's going to be declining enrollment at a lot of major universities around the country, and that even smaller universities may start to close over time. So that's, probably the biggest thing long term that we have to think about is making sure we're picking the right locations that have staying power, and long term will always have a strong student base. Because that population, those population trends are a real thing, and enrollment will start to fall off here in a couple of years.
Interesting. Well, look, I appreciate all the input and insights that you have, and it really sounds like you and your organization are at the cutting edge of this type of student housing, and I wish you and the group much continued success and future deals, and excited to see where it goes in the future, and I appreciate you sharing your thoughts with us today.
Of course, yeah. Thanks for having me. I enjoyed it.
So that is all the time we have. I wish we could do it some more, but we all have other things to get on to in our day, and so we'll let everybody run. To our viewers and our listeners out there, thank you again for tuning in to the show. We'll be back here next week with more Let's Talk Real Estate. I want to say thank you to the whole team here at OC Talk Radio for everything that they do in terms of putting the show on every week. And I am Barry Saywitz, president of the Saywitz Company. If it's Tuesday, we're talking real estate. We'll see you again next week. Thanks for tuning in.
Well, there you have it. You've been listening to Let's Talk Real Estate, your weekly BS with Barry Saywitz about the current state of the real commercial real estate market right here in Southern California. On Orange County's only community radio station, OC Talk Radio, streaming live from our studio here at the University of California, Irvine's Beale Applied Innovation Center.